All right, so today we're continuing our discussion from last year. Stephen Beer is here. He's a CPA who we worked with on a lot of our buildings. And we began a conversation last year on budgeting. On the expense side, this year we're going to talk about on the revenue side. Talk about income streams, hidden assets, and mainly we're going to focus on reserve funds. And proper use of reserve funds, when you can borrow from a reserve. So why don't we start with Stephen, because he's got a lot to say and he's very interested.
Thank you. The basic operations fund is really just to pay the staff, to pay the utility bills, to take care of all of the bills that go on. So that's basically what everybody thinks of as their monthly carrying charges or maintenance. The other items can be charged separately, but prospective purchasers have a lot of concerns about special assessments. If they see it on a financial statement or they know about it, there are some concerns about a buying. Is this going to be the end? Will it continue? So the trend has been to get away from doing it as a special assessment. So as we're working up the budgets and we're coming up with the numbers, now it's time to think about what are these other items that we should be doing. When we do have a time where there are bills which are out of character or out of what we projected, we have to have some way to deal with those. So a good example was this past winter. We had the third coldest winter in 50 years. I heard the word polar vortex more than I care to remember. At the same time, fuel oil prices surged, partly because of the cold, partly because of other reasons. So any building that was utilizing fuel oil only this winter, normally the budget process is 2/3 of the usage takes place in the first 6 months of the year and 1/3 in the last. Almost every building that used fuel oil had utilized its entire budget by the summer. So the question is, where does that money come from now? And a operational surplus account or a working capital reserve is the second type of account I'd like to discuss, of that we have something there for when those things happen. Another way would be if there was a lot of repairs in one year that don't usually happen. And I just had a meeting the other day with the annual shareholders meeting where plumbing was the hot issue. Waste lines just happen to be going after 60 years in the basement, and it's a big cost. It's not part of what generally is considered reserves because it's not capital. It's normal breakage of pipes that's happening. So the question is, what do you do in that situation? So when we're thinking about what we want to fund, the second type of fund is, what do we have to take care of these types of items to at least get us through to pay the bills? And we're going to talk a little bit about borrowing, because that's what's necessary when you don't have an operational excess account, surplus, or reserve fund, that you need to borrow funds from your other fund in order to pay it. The designated or the capital reserve fund is generally one that is set aside for only major repairs and replacements. So the IRS definition of that is some type of work that is going to extend the life of the building at least 1 year. So it's something that's going to make the building last longer. It's not fixing a pipe that just happened to break or damage from a flood that came from a pipe that burst. It's solely for something that's going to extend the useful life. And the industry has that. Prospective purchasers are saying, what is in the reserve fund? How much is there? That's a question that's out there. That creates a quandary, because wherever we set the reserve fund, there's a level that we can't go below, because our financials are not going to look good to prospective purchasers that we have too little of a reserve fund. So a lot of times, that's the conversation that I need to have with boards is, yes, you have these funds, but we need to have a certain amount when we're done, or a plan to replenish that in order to resolve the concerns of very sophisticated purchasers that are in this market. The other thing for our capital for the reserve fund is when the funds are set aside for that, for income tax purposes, there's a benefit for the unit owners. So it's not the regular monthly payment, even though it may be included in the monthly payment, it's not considered part of the monthly payment. Since it's designated for major repairs and replacements, and we follow the IRS regulations, that we tell people in advance that that's what it's for. We segregate the funds into a restricted account to be used solely for a certain item, and then ultimately use it for that. We've created what's called an addition to basis, or the purchase price of a unit owner's apartment. So there's a benefit here of keeping track of it and knowing the different apportionments and where the funds are and what they are, and reporting it back to the unit owners. On the accounting side, we have to keep track of the funds. The financial statements have to show a prospective purchaser or an owner how the funds went, what funds are restricted if they are restricted. So there's an aspect of that in the accounting industry that we need to keep track of it. So we do find sometimes boards will say, but we have such and such amount of money, and we need to delve into the details of the apportionment of the funds before we can really determine what can be used for what. And some of the items which we see in the industry are that there's not always a clear line to determine what each bank account is. There are changes in board members. There could be a new treasurer who comes on from another, replacing a treasurer who's been on for a long time. There may not be the right transition of information. There can be confusion as to what bank accounts are for what. Argo does a great job of keeping track of it and letting you know in your presentation in your monthly report, but sometimes we don't see that. And it's important that they either be clearly designated in the report or even in the title of the bank account. The banks will let you put a subline under the name of Capital Reserve Fund or whatever it is to make it easier to make it clear what the funds are for. The whole goal here is the smooth operation, the adequate funding, the ease of the board running the building. Let's face it, the boards are all volunteers, board members are all volunteers. They don't need to work hard at this. So we want to make sure that up front we're dealing with it in the budget process. We're segregating the funds to keep in line with IRS regulations. We're ultimately using the funds to comply with the IRS regulations and following that into the financial statement. And we have a set plan where unit owners can feel that they are comfortable that when they pay their monthly charges and potentially other assessments, that money's going where it needs to, it's being kept track of, and it's being used, and they can enjoy the building and not have to worry about further funding. Another way of setting aside funds, and a lot of times this is a smaller building, so I'm not sure if it'll be applicable, but I just wanted to touch on it, is there are non-recurring costs that come up, and it's easier to put aside the money every month to try to keep your budget clean and to follow your cash balance. So the best example is the real estate taxes on the co-ops, is that every month generally a certain amount is put into a separate bank account. So this is sort of an escrow for funds that are going to be needed in the future. That's not of the types that I've mentioned before. That then, when the quarterly real estate taxes are due, the money is available to pay the taxes. So we don't have that the money went to pay plumbing bills, or my example of high fuel oil prices, fuel oil, and my gosh, we don't have money to pay the real estate taxes. So it's a very good budgeting process to escrow for funds. You can go to another level on it. A lot of the buildings lately on insurance have been using insurance financing. They don't have to pay the payment in advance. So they pay an interest rate of 8% while they make the payments on the insurance payment. But there are other buildings that will escrow on a monthly basis for the insurance. They have this set up working capital, and then when the bill is payable, they just take it out of the escrow and pay the bill. So that's another kind of non-recurring expenses that we can escrow for. And I have a very small building that they have very tight budget. They escrow for a number of things. So there's a whole list. They do water and sewer charges. They do all kinds of things. And then as they need the money, they pull it back. And they look at their accounting for this escrow account to see if they went over anything, and where they need to replenish, they do. So they have a very tight handle on the finances. They don't have to be concerned that the funds won't be available. So I just wanted to mention the escrow accounts.